Hi, this is Shelley Kraft. We're coming to you live on SNNLive. We're at the Global Hunter 100 Energy Conference here in San Francisco. With me is one of those 100, Trevor Folk of Shoreline Energy, symbol SEQ on the TSX. Trevor, welcome back to SNNLive.
Great to see you again, Shelley.
It's good to have you. Okay, before we get an update, tell us a little bit about the company first for new interested investors.
Okay, Shoreline is a junior E&P company, head office in Calgary, Alberta, core property in Northwest Alberta. We are listed on the TSX, and we are the only junior oil and gas company in Canada paying a dividend today. And we are currently producing just shy of 2,000 barrels of equivalent a day, about 30% oil weighting.
That's pretty good. And the only dividend-paying company in the junior sector?
As far as we can tell today, yes.
Well, those of you who are collecting, congratulations. Where do you go from here, Trevor?
Two things. The remainder of this year, we're continuing our development program. So we have an additional six wells to drill, all light oil, horizontal, conventional light oil wells. Total expenditure about $12 million. Gets us to about 2,200 to 2,500 BOE a day by the end of the year, which would leave us an average about 42% oil weighting. From there, we're currently evaluating several transactions that would ultimately double the size of the company by the end of this year.
Now, where does the name Shoreline come from? Because, people know, I've heard of offshore oil, onshore, shoreline? Come on now, where did that name come from?
So, geological reference, we are drilling into an H&C bed in Northwest Alberta, about 2,000 meters deep, and it's simply the beach. Used to be a beach. We're drilling in, the oil's trapped in the sand in that beachhead.
So that means that you're really not drilling through hardened rock?
It is still a rock formation, but it is a porous rock. So we're drilling conventional oil wells. It does not require fracture stimulation. This is porous rock. It has pores in it, which the oil is trapped in. The oil flows through those pores much better than the tight rock or shale rock. We do not have to frack this to get the oil out.
I'm glad I asked that question because that's an important question. I mean, so does that also reduce the amount of time that it takes and the amount of, wear and tear on the equipment? I mean, I think that's a good question.
Reduces time, but mostly capital. So we drill these wells and we can complete them and tie them in and start producing right away. If you need to frack it, you have time delays because you have to drill the well, but then you have to get a frack crew in to actually frack it. And then the cost to do that could easily double the cost of drilling the well. So these wells are $1.5 to $1.8 million to drill, complete, and tie in. If you had to fracture stimulate them, you could easily add $800,000 to $1.2 million to frack them.
What's your background?
My background is commodity trading. I ran commodity pools for about a decade. At some point in that decade, I decided I wanted to own the underlying assets of what we were investing in. And so we phased out our analyst team and phased in an oil and gas operating team. And we started to buy real property, oil and gas producing property, as opposed to trying to buy oil and gas on the open market.
So now, markets have ups and downs. Right now, we're probably in one of those kind of downs. But nothing lasts forever. So you're probably in a position to have a very positive future, aren't you?
I would say, first of all, the company has a clean balance sheet. So for working this out or working through a tough commodity price environment, we still have capital available to continue drilling our oil. But for the most part, the unique thing is all the acquisitions we're working on right now, we are evaluating them, pricing them, and paying purchase prices based on today's commodity price. So should commodity prices increase, we didn't buy at high prices like $100 oil or $6 gas. We're buying at today's prices. So any upside is on our bottom line. We're not overpaying and we're not stuck with legacy issues such as paying too much and being over-levered.
So, ladies and gentlemen, this is where having a trader running an oil and gas company is very much of an advantage. Wouldn't you agree?
Yeah, for sure. In addition to that, we've been pretty aggressive on our hedging, and it has paid off. It has protected our dividend over the last year and a half.
Okay, let's get a website.
www.shorelineenergy.ca.
So look for information coming out in the future, and I understand you will be in a upcoming issue of the Microcap Review. Isn't that so?
That's great. We look forward to it.
That's exciting to have you in, let me tell you. Ladies and gentlemen, we are with Trevor Folk of Shoreline Energy, SEQ on the TSX, and we are at the Global Hunter 100 Energy Conference in San Francisco. Now all I have to do is get all the other 99 companies to interview their CEOs, right?
Sounds like fun.
Thanks a lot for coming on
Great.
this.
Thank you, Shelley.